Good evening. Wow, this is like a class, right? Oh, it is a class. Right? Well, so what I'm going to talk about quickly is a summarized version of how to avoid mistakes. Page look down and show you how to use knowledge to invest. But what I'm going to at least explain to you what we know from years of research on how the mind works, and sometimes the mind tricks you into doing things that you think is the right thing to do, but over the long run it turns out to be wrong. Okay? Like you said, many times you trade on rumors, and when everybody is buying in the stock market, and the market, there seems to be a momentum, and what happens? You have momentum chaser. Okay? So you chase after the momentum, and you're afraid of missing the boat. So this is what happens when you become kiasu. Right? So the Singaporean here will know what I mean by kiasu, because you see all your neighbors and all your friends, the wealth increasing because they made the right decision. You want to join and get on the bandwagon. But if more and more people get on the bandwagon, it's just the law of supply and demand. When demand is high, supply is less, what happens to prices? Go up, right? Okay, but prices cannot be going up forever. You have to look at the fundamental. Okay, one of the gauge you might want to think about would be the PE ratio, the price to earnings ratio. The price of the share divided by the earnings of the company. That ratio cannot be going up until forever. Okay? Right? After a while, people realize it could be oversold, and then the selling starts. And then what happens? Okay? If you have deep pocket, you can afford to take the hit, then maybe you can ride it out. But most people don't have pocket like fish, so you can ride it out. Especially worse if you go on the margin, then the margin call and all that, right? And then what happens? When prices goes down, people panic. So you see patterns like this again and again and again. Okay? So I don't want to repeat this because Trish has said, how to go about identifying goal and then evaluating, and these are all the stuff that we mentioned before. But what I want to talk about that is more important is this cycle. And we see this cycle day in and day out. Okay? So what happens when you see a stock market trending up? Okay? You see human behavior. When the market is going up, people are buying, your neighbors are making money. Right? There's some overconfidence in the market. The sentiment in the market is very strong, very positive, and people start buying. And greed kicks in. This is where you get greedy, and you think that it's going to last forever. Right? So what happens? People do buy at the top. Okay? And then when the prices start correct, there's some correction in the market, okay? You go into this denial mode. Don't worry, it's just a temporary thing. People are just taking profit. Okay? Right? And then the prices go down some more. Right? And then you start worrying. As an act of desperation, you cannot take the hit anymore. What do? You start selling. Okay? So you ended up, instead of the age-old knowledge that the investment guru tells you to buy low and sell high, what do you do? You ended up buying high, selling low. Right? And then what do? You go buy here, sell here, you repeat this until you go broke. Basically. So the trick or the strategy is basically to be able to buy somewhere here and take profit somewhere there. It's very easy to say, but very difficult to do. Okay? So some of the tips that our guest of honor has touched upon is very valid point, because you really want to invest. And look around this room, you're all young people, and young people, you can afford to take risk, okay? Afford to invest, and leverage can be good. And most people do make their money, in the real estate market, and because they are able to buy when nobody is buying. Very important to understand macroeconomics. Okay? Very important, because if you look at housing prices, I've spoken this in other seminars, my money seminars, about prices is all driven by supply and demand. If you know that there's going to be migration of people into the city, right? What's going to happen on demand for dwellings in the city? It's going to go up, right? And if there are more people choosing to call Singapore home, then people want to immigrate out of Singapore, then what happens? It's all driven by demographics, right? So it's going to move from a population. I remember when I left Singapore in '82 to go to the United States, there were only 2.5 million people living on this island. When I came back to Singapore in 2000, right, there are 4 million people on this island, and now we have 5.5 or 5.3, plus minus a little bit. So when you have more and more people wanting to live on this island, it creates an excess demand on dwellings, and as a result, higher supply than demand, you see prices move. Okay? And then you see speculators or investors owning more properties than those who are getting it for ownership and to live in their property. Then you get even higher excess demand. That's why you see the cycle going like this. Okay? So it's very important to understand macroeconomics when you're investing, and always basically try, to avoid, sometimes think about contrarian type of a strategy works. Okay? You have to basically write this out. Okay? Back in 2000, I shared the same experience as Page. When I came back to Singapore during the crisis, basically on my portfolio, I worked, my savings go into the 401k plan, and after putting all those investments in there, in 2000, what happened to during the dot-com crisis, the dot-com bust, my portfolio get half, right? If I panicked and I sell out, I will be in trouble. So what do? I just write it out. And when you write it out, basically you come back again. If there's one thing certain about the stock market or any market, is that over the long run, what's going to happen to the market? Over the long run, not long run, it's not 1 year, 2 years, 3 years, 4 years, 5 years, but long run over 30 years. Over 30 years, prices tend to be higher. Okay? Right? If you look at anything, if you look at an investment of the S&P 500, let's say in 1929 until today, okay? What do you think will be the return if somebody bought the S&P 500 in 1929 and keep it until today? What would be the average return over this 80-year period? The average is around 10%. Okay? So if you can write a 30-year, horizon, by being lazy, laziness earns you how many percent? 10%. That's not bad, being lazy. Being lazy earns 10%. Pretty good. Okay? Right? Okay. So anyway, so you can think about 10% as being some kind of a benchmark over 30 years if you are putting money in a well-diversified portfolio. If you want to earn more than 10%, this is where you have to basically, adopt some of Pish's advice and put some money aside and then go for those long shots. Right? But at least you understand that if you put in your investment in S&P 500 over 30 years, a well-diversified portfolio, on average it should be giving you a 10% return. But the caveat here is 30 years. Okay? Right? Over 1, 2, 3, 4 years, it can be minus 40%. We have seen that before. Okay? But over the long horizon of 30 years. And who have an investment horizon of 30 years? Who? Students. You guys. I don't. Okay? Professor Bosch don't. Okay? Right? You guys. So over 30 years, if you are being lazy, right, you can expect to earn 10% over the 30 years. okay, by putting your money in a well-diversified portfolio. Okay? Now, if you look at this slide and you look at all the different rates, okay, all these are ex-post rates, that means these are after the fact. But what about ex-ante? These are all the expectations. Prof. Bosch already told you what is the expected inflation rate. So the expected inflation rate, if we look at the history of the market, you can think of it around, over the long horizon of 30 years, around maybe 3%, plus minus, depending on the type. So 3% is the average. So it can be 2% in some times, 4% in other times, but you can think of it as some kind of a long-term average. Okay? And then you can also think about the US Treasury bond market. And because the 3% is the expected inflation rate, then basically if you put your money under the mattress, you will be poorer by 3% every year. Okay? So if somebody wants to entice you to park with your money, default free, you get your money back, it has to earn 3% or more. Right? So you have access to the world capital market, the bond market, to the US Treasury bond market. You have inflation protected, inflation adjusted or pegged investment, then at least you can earn the inflation rate. But that is just being status quo. Okay? That's just protecting your capital. It's not doing anything more. But if you want to do more, you want to increase your wealth, then you have to basically take some risk. Okay? Right? And the horizon, the long investment horizon like you guys and both of you guys have, it is a possibility. Okay? So if you look at some of the markets, Singapore market, US equity market, if you look at the long run, right, some years it is up, some years it is down, there's a lot of volatility in the market. If there's any constant in the market these days, it is volatility. Okay? And the volatility could be attributed to many things. One of those things could be the technology, the speed of receiving information. These days you get information very quickly, and also there are more and more traders out there, and also you have program trading. All the machines these days are trading on people's behalf. Okay? That could contribute to some of this volatility that we see in recent years. So volatility is around to stay. So how do you write the volatility? Basically, don't over leverage. Okay? Now, I want to, there are a couple more speakers, and I really want you to listen to the next two speakers. I'm going to take you all the way to one of the slides. Okay? Now, so remember, you want to take risk, but before you do that, you have to think about your investment philosophy. Okay? And you really have to control your emotion. Many times when you are investing, you are invested in the market. When you have money at stake, people get emotional. When the money, you start looking at all your holdings and the value of your holdings start dropping, you get emotional, and people do strange things when they get emotional. Okay? Your stomach basically starts to churn. Okay? Alright? When the stomach starts to churn, and then suddenly you fear, and what do? You ended up selling when you don't need to sell, when you should not sell. Or you buy when you shouldn't be buying. Okay? So many things like this are easier said than done. Right? It requires a lot of discipline in the market. Okay? So I want to take you to this slide over here. If you are thinking about your investment horizon of 11 years or more, right? Then if you look at your risk appetite, the higher, moderate, and lower, right? Some recommendation for those of you who has a very big appetite that you want to be, fully invested in the stock market. If you are more conservative, then you want to basically have some cash, some bonds, and some stocks. Okay? But if you are 20-some years old, at the minimum, you want to be exposed in the stock market rather than in the bond market. Even though if you are really sophisticated bond market investors, you can do very well. Okay? But that requires skills. Okay? But if you want to be lazy, okay? I got no time, I got a day job, I just want to put in a well-diversified portfolio and don't have to worry about things, then you can start investing. diversified portfolio in ETFs and over 30 years, on average, history has told us that you should be making around 10%. Okay? So anyway, so if you look at life stages, it's the same thing. You go from basically going to school, starting a family, building a career, having children, and then enjoying your golden years. You go from being here to there, and the type of portfolio you choose is all about asset allocation. How do you split your investment into stock versus bond. Okay? So when you are a lot younger, and you can take higher risk, you can do so without worrying about the downside, because you can always ride the cycle. Okay? And also take advantage of leverage. Okay? Right? Because time is on your side. But when you are somewhere over here, okay, right, we are getting closer and closer to retirement, and you have to start thinking about rebalancing your portfolio. And that's where you start investing more in bonds, protecting your capital more than anything else. Okay? So this is kind of the same picture, talking about how your asset allocation over the different age. Okay? Anything is all about asset allocation. Right? Now, so this one you've seen before, about knowing yourself, know the product, and know the strategy. Right? I want to show you this one. This is a very important slide. If you look at this slide, these are all the different asset classes. Okay, the worst performer to the best performer from 1995 to 2014, and it looks pretty random. Okay? Meaning that 1 year, in 95, large cap, value stock makes 38.4%. 96, large cap growth, 23.7. Large cap value, again, 98, 99. And then look at 2000, 2001, 2002. Fixed income are the winner. And you look at large cap, they are down here. Okay, just a year ago they are up here. Okay, so if you look at this, then you have to realize that maybe it is really difficult to predict when this is going to happen. Knowing some macro effect, does help, at least to spot where the trend is coming, whether or not the market should turn. But when market turn quite violently. Okay? I do also have stories about buying shares, that I think was okay, and then overnight, they 30-cent a share became 4 cents. And ended up thinking that, maybe it's just a temporary dip, maybe I should just average down and buy some more. So he bought more and it went down to 2 cents. Okay? And then what happened? He said, cut loss and get out, Right? Sometimes have to do that. Okay? It happened to the best of us. So anyway, so if you look at these asset classes, you realize that your best bet, unless you can predict all these asset classes, is to basically have a diversified portfolio. Also bearing in mind, you really need to put aside, some to really, look for those long shots. And those things, if they happen, that can really, really make a difference. Okay? Right? And don't get greedy. This is a slide that I put up there to remind people. Because when you're young, you listen to people say, oh, you can make some money doing A, B, C, D, E. If the deal is too good to be true, it is. Okay? So there are many scammers out there trying to scam you, So don't fall. Remember this number. On average, if you are exposed to the equity market, on average, how many percent? 10%. Inflation is running at 3%. So risk-free return should be running around 4%. Okay? So if anybody offering you a risk-free type of a investment higher than 4%, you start to wonder. Okay? Right? Because theory tells you that risk-free return is around, on average, 4% over the history of the developed market. Okay? So, if it's too good to be true, it's too good to be true. Okay? So thank you. Thank you very much.